Hello and welcome to Portfolio Matters Week 2. Thank you for all your kind comments. So we'll now start the cycle of weekly updates. But before we do that, over to Richard for the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Okay, so it was another volatile week. As we predicted last week, what you can expect this year is further volatility. So this week was characterized by a very heavy sell-off in gold last Friday as we were actually doing our first weekly update, and a big sell-off in Bitcoin the same day, which seems to have recovered slightly. So going through, copper remains very high. It fell 1.1% on the week. Iron ore continued again at very high levels, so neither of those seem to show any inclination to cease their current bull run. WTI continued rising, and now at $53. Gold, as we've discussed, came off, and we'll be discussing later in the podcast whether we think that is the start of a bear run based on the rise in US yields, which seems to presage concerns about inflation. Richard, do you want to talk about Bitcoin?
Well, Keith, Bitcoin it shot up during the course of last week, and over the weekend it got hammered, and now it has, as you said, it's regained some of its poise, and I think it's around about 35,000 now, which is like 10% down from the peak that it reached. I think in terms of Bitcoin volatility, it's par for the course. But if you own too much of it, it's horrible. And if you own it on leverage, which I think is quite difficult to do, then presumably it's gut-wrenching. So the best thing to do is to have some of it. If you want to invest in it, own it, have an amount that you are comfortable witnessing and holding through 20 or 30% drawdowns. You don't want to get bounced out on a 5 or 10% drop in the price of this thing.
Yes, well, the 5 or 10% drop seems to last about 5 minutes, so you have to be able to sit through those.
Yeah.
So both the FTSE and the S&P had small bad weeks. For all share down 1.5%, S&P 500 down 0.8%. In contrast, sterling had a good week, and that was despite the fact that we had all this Brexit disruption news, Northern Ireland supermarkets running out of goods, and also the fact that the US dollar actually had a strong week. So in further detail, you'll see
on that to the dollar index, Keith, it's over 50% of the dollar index is the euro.
Right.
So it does. When one talks about the dollar index being up or down, a huge amount of that is what's going on with the euro.
Right. Okay. Thank you, Richard. So this is the chart of gold, and you'll see this enormous fall last Friday, which has since stabilized. But those of you with a technical bent might be thinking that there's a bearish downward channel developing here, and I noticed on the technical charts that the long-term moving averages were getting dangerously close to crossing, which was a sort of bearish signal. However, I remain very strongly bullish on gold.
Can I just show you this chart that I've got, Keith?
Sure.
Can I share over here? I'll share right here. Sorry about that.
That's right.
So this is a chart that shows the long-term relationship between gold and the US M2 money supply. And the interesting about it is that these channel lines have been drawn in, and there is a wide range of movement that the price of gold could actually undertake within these channels, but it is still following the M2 money supply. And I think it's a little bit like with Bitcoin. One of the things you have to bear in mind with gold is that it can be have a very large price range at any given time. And if you're in it for the long term, which I am, and I think you are as well, Keith, you do have to be positioned so that you don't get bounced out by movements that are actually sort of inside these parameters. And again, that's to do with position sizing and confidence in what you're doing and investing for the long term, if that's what you're doing.
Yeah, I mean, the linear relationship makes perfect sense. If you're diluting the the value of the dollar, then the value of gold should rise commensurately.
Yeah.
But when was that chart made, Richard? Because it doesn't seem to show a big leap in M2, which we've had in the last year.
Yeah, not sure, Keith. I don't exactly know. I don't think it's old.
Right.
Do you know what the current M2 is?
In the US, no, sorry.
No, we'd have to check that, and then we'd.
But it's leapt by about 20% this year.
Yeah.
So you'd expect there to be a change in that chart.
Yes.
Anyway, let me return to the slideshow. So, Bitcoin, sharp drop, sharp rise again. So, frankly, it looks like Bitcoin has resumed its rocket-shaped formation. And I mean, I won't attempt to predict where Bitcoin's going to go, but when we started this podcast, I think the main prediction for this year was volatility, and I expect to have a lot of volatility.
Yeah.
Now, there has been a lot of commentary about the rise in US 10-year yields and whether the market is suddenly discounting inflation, and a rise in real 10-year yields means that the cost of funding has gone up. And so you would expect gold to lose attractiveness relative to bonds. And there's been a lot of commentary saying that the reason gold has come down is from this rise in inflation expectations. However, I'm very skeptical.
I'm skeptical too. I think that I think a lot of people spend a lot of time searching for reasons for things, for asset prices moving, and that aren't necessarily particularly well correlated in the longer term. Now, there is a good correlation between yields and the gold price in the long term, but we don't actually know why there's a short-term movement in yields, and nor do we know what the Fed is going to do if yields go up very much more.
Well, I completely agree with you, Richard, about the fact that there's a lot of volatility and commentators exist to try and explain the volatility. I remember some years ago listening to a podcast by a fund manager who was selling a big position in a certain stock. And he was moving the market, and he knew he was moving the market. And he was listening with amusement to all these commentators trying to explain why this share price was going down steadily day after day. And he knew it was him, but they were imputing, lots of different reasons why this was going down.
All of which could have been true, but none of which were.
Absolutely. So here is the difference between the US 2-year and 10-year yields. And that shows essentially inflation expectations, or a steepening yield curve.
Can I just comment on that, Keith?
Sure.
If you look at 2000, we haven't had anything above 2 or 3% inflation, as far as I can recall, for several decades. And, we didn't have significant inflation, I don't think, 2000, 2001. We didn't have it in 2007 to 2009. We might have had 2 or 3% inflation. We didn't have 6 or 7% inflation, which is what I would call a significant level of inflation.
Sure.
And so I'm slightly dubious about as this being anything of any great significance, personally.
Well, what I would say on that, Richard, is that we have had an enormous amount of money printing, and unlike in previous recessionary episodes, the consumer is actually in very good shape with money in their pocket. You're already seeing input price inflation in the form of iron ore, copper prices, in fact, every base metal and energy prices going through the roof. And you're also seeing food inflation.
I agree with that, Keith, and I agree that we may get inflation as a result of it. I just don't think this 2-10 yield curve is a particularly good indicator.
Sure. Okay. I also, like you, question whether we will get sustained inflation as opposed to a one-off spike in inflation.
Yeah.
Okay, so the US dollar index had a bit of a blip up, but as you can see, it's been in this downward channel over the course of the last year. And with all this money printing and Biden coming in and hoping to do a huge amount of stimulus, then you'd expect the dollar index to keep on declining just because there's so many new dollar bills coming online.
Yeah.
Now, when I said that I was skeptical about the explanations for the recent volatility and the sell-offs, one of the reasons I'm skeptical is because I think it's entirely seasonal. If you look at this, this is the seasonal chart of the performance of the S&P throughout the year. And essentially, every year, you tend to get a strong fourth quarter. And in particular, you get the Santa Claus rally. The Santa Claus rally happens in the last 2 weeks of December. It's possibly one of the strongest of seasonal effects there is. And that effect tends to last into the first week of January as fund managers reposition their portfolios. And then there's a reaction as people take profits. So the latter half of January tends to be quite poor.
I think that's a very interesting chart, Keith.
Thank you, Richard. So generally, I notice also that commodities in the previous recoveries from recessions have tended to peak in March. And here you see in the this seasonal chart, you see that from the second half of March, there's quite a strong recovery from the lows in February. Anyway, so that's what I think is going on.
Thank you.
So to complete our weekly checklist, you'll see that obviously interest rates on both sides of the Atlantic remained exactly the same at very low rates. And the spike in interest rates we saw last week has dissipated in that the bond yields have continued to rise, but at nowhere near the pace they rose last week. So whether that will continue or is just a one-off piece of risk aversion, we don't know. And that's it. Shall we talk about our personal portfolios and what we've done briefly?
Yes. Shall I go first with that one, Keith?
Sure.
It won't take terribly long. So, in my portfolio review, I was down 2.8% last week, basically due to the same reason I was up the previous week. So, c'est la vie, really. Easy come, easy go. If you recall, I sold most of the shares that I had in the battery technology last week, and I followed Keith's advice and I purchased some Techmar. And thank you for that, Keith. And they're currently down 5.4%. So, but I'm in it for the long term.
I'm amazed, Richard. I'm sorry about that, but I'm also amazed because I didn't think the share price was down that much. I thought it was kind of flat. I have to have a look.
I might have bought them on a spike up, Keith. Perfect.
It's probably you that caused it.
Timing.
Right.
I'm afraid that's me. Very, very unexciting. But then I do aim to trade as little as possible and hold my shares for a longer period of time.
Very good. Okay, I similarly had a relatively low activity week. So I was down 1.25%, and that was mainly, well, that's partly due to shares, but also, of course, I hold a lot of gold, and gold had a poor week. So I started selling my Glencore. Now, in my SIP, I bought that fairly recently and have only made about 12%.
Mm-hmm.
But that
why
is
are you
something.
selling it, Keith?
Well, I just think that, as we discussed last week, metals prices just seem so extraordinarily stretched.
Yeah.
I mean, I fully realise that Glencore is very cheap compared to the others, and that if they were to get rid of their coal assets, the whole company could re-rate north.
Right.
But the reality is, I don't think there's any sign that they intend to get rid of their coal assets, and so that's sort of a jam tomorrow argument.
Yeah.
And so I've sold a tenth of it, and I'm going to slowly get out of it over the course of this quarter.
Okay.
Now, the one company I sold and I want to talk about was Turquoise Hill.
Mm-hmm.
Now, I know Richard, when he selects his miners, avoids dodgy jurisdictions, and I don't. Perhaps I should. So,
if you're showing us the disclaimer.
Yes, well, Turquoise Hill owns the Oyu Toglu mine in Mongolia, which it has been struggling to develop for the last 7 years.
Right.
And it is massively over budget, over time. Rio Tinto are the developers of the mine, and they own most of Turquoise Hill, and the Mongolian government owns the other part. Now, this is a very high cost producer. If you look at all the charts, it's the highest cost copper producer in the world. Yeah. But with the copper price flying through the roof, it's clearly geared the most the copper price, was my thinking when I bought it in the early December. And that was a good calculation, until, being in the dodgy sort of jurisdiction it is, the Mongolian government came out with a statement saying that they were unhappy with the mine development plan, and they wanted to, they were potentially going to cancel the license, etc., etc.
Oh, right.
To spike down in share price to essentially where I got in. And at that point, I thought, actually, just get out of this.
Yeah.
So
you don't want to be riding that sort of uncertainty. It's just not worth it, is it?
Yeah, there are other opportunities. You don't need to own everything. And the reason I bought it was that it was highly geared to the copper price, but actually I have no insider information about how these disputes between Rio Tinto, Turquoise Hill, and the Mongolian government are going to resolve themselves. And they could go in any direction. It's the sort of situation I hate, because I have no information on. So naively, if you look at this chart, I was hoping it was going to get to $15. I had some limit orders. It got to 14.6, and then it crashed.
Oh, a narrow escape, Keith.
Well, yeah. Those, if it got to 15, it just needs to tick a lot, 15.01, and I was out. There you go. Okay, so what did I buy? Now, I'm going to bought 3 stocks, 2 of which we're going to cover over the coming week. So I bought an interesting gas play listed in London, but whose operations are in the US, called Diversified Gas and Oil. And that has a dividend yield of 10.7%. And I'm currently doing some digging and will be presenting that over the course of the week. I also bought a tiny gold producer with quite an interesting and innovative business strategy called Goldplat. I also bought a spivvy oil company called Pharos Energy. I continue to bottom fish in the oil producers.
You enjoy it, don't you, Keith? I noticed that given free rein, you'll be fishing the bottom rather than skimming the top.
Well, I think that's true, because I think we are the bottom of the cycle, essentially. So when we talk about this during the week, Goldplat, I looked at 6 months ago, and I thought because its market cap was 3 million, it was just too small, and I didn't really do any digging. Now its shares have trebled, and it's at 10 million. Suddenly, it's on my radar, and I'm thinking, well, actually, this kind of market cap screens I use, perhaps I should just, dig a bit more deeply. Of course, you can't look at everything.
Yeah.
But anyway, yes. In summary, Richard, you're right. I am digging around the small caps.
Yeah, it's very interesting, Keith.
So that's your lot. Thank you for joining us this week. If you've enjoyed that, I hope you will press like and subscribe to the channel. We can be found at info@portfoliomatters.co.uk, and we will be during the week producing some share talks and my worst trade, which will be me this time, and I'll hope you'll join us for those. So all that remains to say is goodbye from Richard Wheater,
and goodbye from Keith Jordan.
Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.